Welcome back. This is Chart Overload. I appreciate you joining us. I'm Ryan Mumy. That's Justin Greenhill, also known as JG. We're the founders of Sollinda Capital Management. This is our video series where we get together every couple weeks and just talk about charts. A lot of charts. I got to guest conduct a high school wrestling practice tonight, so it was good to be back in there. But Justin, I will tell you that I'm not in wrestling shape. I'm good for about 20 to 30 second goes, and then I have to let other kids come in. But it's fun to be out there helping the future of America. But anyways, let's get right into the big picture. First chart is coincidental, maybe, the Big Book 1929 by Andrew Ross Sorkin. He rang the bell on the New York Stock Exchange.
Yeah, this is one of those things that if we're not in a simulation, it seems like it. But a book about the Great Depression that was kind of designed to draw parallels between today and the Great Depression. They rang the bell at the New York Stock Exchange to promote it on what was, at least for now, the exact top in the market.
We're gonna release that here first, just in case. But who knows? But Brent Donnelly, who we follow, he talks a lot about media, newspaper or Moody magazine covers and their correlation to whatever theme they're touting. So that it'll be interesting to follow. Just not that there's any signal there, but it's interesting. Next chart looks at the weight of the top 10. And then the next 40 stocks in the S&P 500 over time, going back to the 60s. And as we've talked about, the concentration of the top 10 is pretty big.
Yeah, and that black line pretty much shows it. I mean, it's, I don't even know the word to use, I guess, but we'll call it unprecedented.
Historic? Yeah.
Yeah, and what's interesting is, the people that defend the concentration in the U.S. market will point to the fact that other global markets are equally as concentrated, whether it be Korea or Taiwan. And that is true, but, the American stock market, at least historically, took pride in the fact that it was a very diverse marketplace that wasn't just driven by the biggest companies. So although we hear that pushback, it doesn't change the fact of what is. And what is that a small number of companies dominate the market.
And it's at historic levels, while the next 40 are at lows, right? Or down trending towards the lowest area, which again, there's no signal here, but you've got to pay attention to this.
Being aware.
If you buy an S&P 500 index fund, that's not recommendation, but if you do it, just know that's really concentrated. It may not be as diversified as it once was, and this chart shows that. Next chart, again, I found this interesting. It was on Bloomberg, pulled it off the terminal, and it just shows the correlation of Bitcoin to the FANG stock index, the biggest of big tech companies. And as we see here, they've kind of moved in line until recently.
Yeah, and I spent a little bit of time thinking, we see the correlation being very positive, and I think we've talked about this many times over because it has been the case for really a couple years now, if not longer. And if one had to explain why, you could just say that, Bitcoin has become mainstream, right? It's over $1 trillion market cap. It trades in some form or fashion 24 hours a day, 7 days a week. And as such, it tends to have not only a positive correlation, but in a lot of instances, a bit of a lead in terms of, what the big tech stocks are going to do. So it's worth paying attention to as well.
Yeah, I mean, we'll see, because Bitcoin has given up all of its year-to-date gains up to this point, and the NASDAQ hasn't fallen that much, right? So either this is something or it's really not, and, the lines will come back together. Next chart looks at consumer spending, which we talked about last chart overload quite a bit, because Chipotle had just released their earnings and talked quite a bit about the consumer slowing down on their expenditures, especially in restaurants. We talked about the K-shaped economy, how higher net worth folks, higher income earners, there hasn't really been a dip in their spending while the rest of the economy there has been. Well, this just reaffirms that consumer spending is slowing.
Yeah, I mean, there's not really much more to say other than the fact that the evidence has continued to come out that shows this year has seen just growing consumer weakness the whole time, right? So, which kind of goes to what we've been saying. The economy's been driven by the AI capex story, and either the consumer is going to continue to flounder, or there's going to be potentially a pickup into next year, and that could carry its own investment implications.
It could pick up weight, and really supercharge things. I find it really interesting that this is happening right at a time when the buy here, pay later world is there's lots of people doing it, and not just for electronics, if you will, but for groceries. And it's to the point where Congress is looking at it. It is that predatory, what's often viewed as predatory lending, becoming too widespread when you can click it on any Amazon purchase. So again, consumer, pay attention to it. It hasn't mattered, but at some point will it? That's kind of Justin and I's point. And then the counter to any bearish news out there, we have seasonality, where we're entering that time period when the market traditionally does very well. We're in it. And second is this fiscal bazooka that's right around the corner. This next chart shows what it would look like if the big beautiful bill comes to fruition, starting in 26 and then on through 2034.
Yep. Basically, this is just showing that the deficit is going to be pouring billions and billions and billions of dollars into the economy for the foreseeable future. And next year and the year after are pretty much a lock in terms of it being, the maximum expected amount. And then after that, a lot will depend on whether or not, some other conditions that are within it get renewed by, assuming who takes over the Congress in the midterms. But regardless, you've got a tailwind of the deficit, now lower real interest rates, as well as some actions in terms of what they call the Treasury account at the Fed, that all are looking to provide some pretty strong liquidity into both the economy and the markets over the next 3 to 6 months.
Yeah, that TGA is a tailwind on top of this, but then also you wrote about this, the tariff. If the Supreme Court strikes down the tariffs, that's another couple $100 billion that's going to be returned to businesses that'll obviously be available to be pumped in the economy. So that we called it the fiscal bazooka because it's coming from three sources, but it's big money. I think Justin did the math, and it was 2.5% of the GDP. I mean, it was a big number. So that's something to pay attention to. Moving into domestic stocks, this first one just shows that the S&P 500 closed below the 50-day moving average. That's a pretty widespread watched measure, but it did happen.
Yeah, and as you can see here, there are some kind of false moves below that. False meaning that the market jumps right back above it and keeps moving higher. But generally speaking, there's not too many times where you wouldn't at least want to be aware of that being a potential trend change. So, we're filming this here at nighttime on a Wednesday, and the market might jump back above that tomorrow. But either way, it's safe to say that for the bull market to continue, we can't be trading sustainably lower than that.
Yeah, and I mean, so NVIDIA reported earnings after the close today. Did NVIDIA save the market short term? That might be headlines over the next couple days. But again, it's something to pay attention to because, as Justin said, if it doesn't regain it, that's a pretty significant trend change in the market that investors should at least be aware of and maybe take some action on. Next chart looks at equal weight, which again is if instead of overweighting the larger companies in the S&P 500, it's equal weight where everybody gets the same share, and it's had a much different chart than the regular S&P 500.
Yeah, this is one of those dynamics that we've talked about a decent amount of late as it pertains to the small cap index, Russell 2000, but then now also to the equal weight, where you've had these big companies lead the market higher in what is a concentrated S&P 500 market cap, but both equal weight and small caps are either right at or now back below their prior highs. So not only does that kind of give a signal in that we might be entering into a risk off mode, but we think even perhaps more importantly, when those two gauges do get back above those levels, having kind of traded around them for now quite some time, that's a pretty powerful signal to say that we might just be entering a new bull market for everything that's not the biggest of big companies.
Which nobody's talking about, right? Nobody's talking about that. AI is still the dominant market theme, if you will. Next chart looks at gamma levels of the S&P 500. Again, gamma, if it's in negative gamma, then that means the market makers are juicing the direction of the market. They're having to trade with it. And if it's in positive gamma, then it acts as a stabilizer where if the market's going down, then market makers are buying and vice versa. It's something we have to pay attention to. And this just shows a scatter chart of gamma levels.
Yeah, what we like about this chart is there's a couple ways that you could illustrate this, but it basically shows that it's indisputable that the market does move more in both directions when it's in negative gamma than it does when it's in positive gamma. So that's not to say that you should necessarily expect a crash to happen, but the conditions for higher volatility are there when that's the case. And oftentimes higher volatility does happen more on the downside than it does on the upside. Up moves are more of a kind of a steady grind. Down moves are more of a, in recent instances, a crash. What do they call it? Escalator up, elevator down.
There you go. Yeah. So again, it's a weight of the evidence. It's one piece of the pie, but it's important to be aware of it that volatility tends to, if volatility doesn't come down, it's most likely going to go up in negative gamma scenario. Moving on to non-U.S. equities. First chart looks at emerging markets, which have been left for dead for a long time, and this shows they've had pretty remarkable returns this year.
Yeah, I mean, it's hard to really appreciate some of these numbers on a year to date. And you do have to kind of look back and remember that we went a decade or so of underperformance relative to U.S. stocks. But you've got the Korean equity index up 70%. You've got the Brazilian currency plus the additional interest you get from being in Brazil relative to the U.S. up, 31%, and so on. And, it's pretty interesting in that if we are in a new reality where these assets are going to continue to perform strongly, we're probably just getting started. But having said that, they've come a long way really quickly. And if we go back to the dynamic of a big fiscal stimulus happening here in the U.S. into next year, historically, when there's a big fiscal impulse in the U.S., that has tended to attract capital into the U.S. versus letting it go elsewhere. So whether or not that does anything on an absolute, we would just say that if you are interested in getting long some of these emerging market assets, you could probably take your time working into it and not need to chase some of these near-term
Chase
returns.
it, yeah. Next chart looks at inflation in emerging markets relative to developed countries.
Yeah, and this is perhaps one of the more interesting, just big picture macro regime changes that's been happening. Normally emerging markets at large, in particular some of your more volatile markets like Latin America, et cetera, have inflation well above what we have in the U.S. But we've kind of entered this new environment where emerging market inflation at large is either right with or in some cases below what we have in the U.S. And many of those countries have double-digit interest rates, yet low single-digit inflation. And that explains a large part of the performance of late that we showed in the prior visual.
Well, and it's some macro commentators out there have said, this is where developed markets start trading like emerging markets. So Maybe they're moving more in sync than they have in the past. Who knows? But that is a very telling chart. Moving on to fixed income, the boring bond market. This first chart looks at the 10-year yield on an hourly basis, and as we've talked about it's trended down for much of the year. Bonds have had a very good year overall, especially the 10-year, first time in several years. But here recently, it appears to have started picking back up to the upside.
Yeah, and that's really all come after the last Fed meeting. The expectations going into the November Fed meeting was that there would be 2 interest rate cuts before the end of the year, and some comments from the Fed, along with some other news items, have now kind of pared those back to where we're now expected to get that second of what was 2 cuts or 1 more by the end of the year. Is really only a 50-50 proposition. And the 10-year yield has been a lot more volatile because there's, back to concerns around the deficit. And typically the thinking is that the bigger deficit, the more bonds they're going to have to sell, and then there could be less demand. So it's not so much the direction of the
Higher
10-year,
yields.
higher yields, and is there going to be more volatility, right?
Yeah. Another piece of the fixed income market that we pay attention to are credit default swaps, basically insurance on various bond instruments going defaulting, going belly up. And one interesting thing we've talked about is that to finance this AI infrastructure build, a lot of tech companies are relying on borrowed money, both in the public and the private markets. And this just shows Oracle's the cost of insuring their bonds. And I guess the only way to describe it is they've went up a lot.
Yeah, and this is kind of another one of those indicators that even though the market is not very much off the highs, it's interesting that there is a decent amount of risk already priced into certain areas of the market around the AI dynamic. And one of those is the fact that Oracle is going to be one of the big spenders, and people have been willing to kind of pay up on the proposition that they're going to get rewarded if there is a credit default. And that's, in most instances for very large companies, a very small probability outcome. So people are looking to hedge. The AI thing is not a one-way street in terms of the mainstream narrative at this point.
Last chart in fixed income just looks at correlations between stocks and bonds, going back to the early 90s. And what we've seen here over the last couple of years is correlations went up, meaning it used to be stocks went down, bonds went up, and vice versa. Now we've seen them more times than not moving in the same direction.
Yeah, and whether or not this is the dominant driver of that or just a correlation is kind of up for debate. But what history has shown that when inflation is below 2%, stocks and bonds tend to be negatively correlated, which just simply means that as soon as the stock market comes under pressure, they're able to cut rates pretty comfortably because inflation is not an issue. Versus when inflation's a bit higher, not only can that inflation be negative for the economy and for the stock market, it makes it harder to cut rates. And that's
which is the situation they're in right now, right? Moving the goalpost to a moving the goalpost to a 3% rate. They haven't said that, but they've implied that, the Federal Reserve. So again, to be determined, something to pay attention to and watch, but we find it very fascinating. And moving on to the last section, commodities. This just looks at the broad commodities index. What we see here is a pretty significant horizontal line.
Lines, yep. And what's interesting about the commodity complex is this particular gauge is, I believe it's in the high 30% to oil. And oil, has been the laggard. So you've seen big moves in some of the metals. You've definitely seen a big move in gold. You've had some of the agricultural complex, but oil is just kind of languished. So, but still, this chart seems to still be moving higher. So tying this into the inflationary dynamic, if oil does start to even just have a modest move higher here, that will be a major change in terms of adding an additional inflation impulse to both the economy. And we would expect that to perhaps pretty abruptly change the both absolute and relative way certain assets are trading.
AKA there would be some volatility injected into many of them.
And the
Because
fiscal
I don't know
stimulus
that,
could be a driver, right, into next year.
yeah, because that hasn't been on anyone's bingo card, right? Oil's been helping on the inflation front, not hurting, and for multiple reasons it could turn. Last chart looks at copper, copper relative to iron ore, and it appears that there's been possibly a change in consumption here.
Yeah, so flip that in reverse. This is iron ore relative to copper. And
Yeah,
basically, the way you can think about this is, for much of the 2000s, the big driver of the economy was building new cities in China in particular, but really throughout, especially China, and that required iron ore, right? You need iron ore to make steel. More recently, iron ore has been oversupplied. A lot of that new city growth out of China has already been realized, and the economy has shifted to where electrification and now data centers, et cetera, are kind of what is built and made when the economy is expanding, and that obviously takes copper and not iron ore. So this chart just kind of shows that if you want to look at the kind of the supply demand dynamics of what's important to the new economy, it's copper and not iron ore.
interesting as always. We appreciate you spending some time with us. That's our chart overload for this time. If you have any questions or you want to chat a little bit with us about any topic, you can email us at info@sollinda.com, info@sollinda.com. We appreciate you spending some time with us. We know there's lots of places you could go. We hope you found it interesting and maybe laughed a couple times, but we'll be back in a couple weeks. We hope you guys have a great week. Thanks.